Welcome to This Explainer. Today, we're uncovering the hidden math your bank desperately hopes you never calculate. I mean, we all interact with banks, right? We deposit checks, swipe credit cards, and pay mortgages. But beneath all those everyday transactions is this fascinating, almost invisible engine of wealth. By the end of our time together today, you're going to see the banking industry in a completely different light.
So, let me just ask you directly. What is the one number your bank hopes you never ever calculate? Go ahead, take a guess. Most people instantly think it's their account balance, or maybe the exact interest rate on their credit card. But actually, it's neither of those. The number the industry really wants to keep out of your head is a hidden gap. It's the space between two very specific data points.
Okay, let's dive into this. That gap, it's called the spread. And simply put, the spread is the difference between what your money earns sitting inside the bank's building and what the bank earns the exact moment they lend that same money back out the front door. And here's the fundamental truth you need to internalize. The spread isn't just some mathematical side effect of banking. It is the entire business. Every single product, every fee, every default setting is engineered to make that gap just a little bit wider.
Let's move into Section 1, the spread machine.
To really see how this works, let's look at a real-world example. Meet our avatar for this explainer, Sarah. She's 34, earns a normal salary, and has the standard financial setup most of us do. A checking account, a savings account, a credit card, and a mortgage. But without anyone ever telling her, Sarah is unknowingly standing on the wrong side of the bank's spread in 6 totally different ways. Truth number 1 is that your deposit isn't actually stored. It's a loan. When Sarah walks in and hands over $10,000, she thinks she's putting it in a secure vault. But the instant that money hits her account, Sarah actually becomes a lender. In fact, she's the cheapest lender the bank will ever find. The bank keeps a tiny fraction on hand and lends the rest straight out to a homebuyer or a credit card holder. And what does the bank pay Sarah, the person who actually supplied the money? Well, the national average savings account pays about 0.4%. So her $10,000 deposit earns her a whopping $40 in a year. Meanwhile, the bank lends that same money out at an average of 7% and pulls in $700. Sarah takes 100% of the risk handing her money over, but gets roughly 5% of the yield. The bank pockets the other $660. Bankers politely call this the net interest margin, and it is absolutely the biggest driver of their revenue.
Section 2, the deposit illusion.
Now, you might be wondering, if there are better rates out there, why doesn't your bank tell you? Well, the reality is, banks build their entire low-cost funding model around consumer inertia. They're literally betting that you simply won't move your accounts. I mean, studies show the average person keeps the same checking account for about 16 years. That's longer than most people keep a car, a job, or sometimes even a marriage. Your silence, your lack of movement, is literally worth money to them. Take a look at the math here. If Sarah keeps $20,000 across standard checking and savings accounts at 0.4%, she makes $80 a year. But there are federally insured high-yield accounts with the exact same FDIC safety that pay 4.5%. That same $20K in a high-yield account earns $900 a year. By doing nothing, Sarah is paying a loyalty tax of $820 every single year for taking on zero extra risk. Over a decade, with compounding, she quietly hands the bank over $10,000 just for the privilege of not filling out a new form. It doesn't show up as a fee on a statement, it's just money that never arrives.
Section 3, the dead treadmill.
Truth number 3 shifts us over to credit cards. Now, what's really interesting about this slide is that whenever you get a credit card statement, there's this small, friendly-looking minimum payment printed at the bottom. Make no mistake, that number is not a courtesy. It is one of the most mathematically profitable sentences ever written in finance, and it's engineered specifically to keep you in debt. Let's break down one single payment. Say Sarah carries a $6,000 balance on a card with a 23% interest rate. Her minimum payment is set at around 2% of the balance, making her first payment about $120. But watch where that money actually goes. The interest for that 1 month alone is $115. So out of her $120 payment, exactly $5 touches her actual debt. Literally just $5. The other $115 is pure rent on the money. That slowness is entirely by design. It makes sure the principal barely moves, so the spread keeps flowing to the bank for decades.
Let's contrast the timelines here. If Sarah only pays that friendly minimum, clearing her $6,000 debt takes her more than 20 years, and she pays roughly $7,000 in interest alone. She literally pays more in rent for the money than the original items even cost. But if she ignores that minimum and simply pays a flat $250 a month instead, she's out of debt in under 3 years and pays around $1,800 in interest. It's the same debt, same card, same interest rate. Changing just one number, how much she chooses to pay, saves her over $5,000.
And this brilliantly illustrates our fourth truth, which hits where the biggest dollars in your life leave the building. The mortgage. Sarah buys a house with a $400,000 mortgage over 30 years at 6.5%. Her payment is about $2,529 a month, but in the early years, almost none of that payment goes toward her house. In year one alone, Sarah pays the bank over $25,000 in interest, while chipping away less than $5,000 from her actual debt. Mortgages are purposely front-loaded. The bank collects its rent first, leaving you with very little real ownership early on. Across 30 years, Sarah will end up paying over $510,000 in interest alone.
But here is the secret to breaking that front-loaded curve. If Sarah pays just $200 extra toward her principal every month, she saves around $85,000 in interest and pays the loan off nearly 6 years early. Now, the bank isn't technically hiding this math. I mean, they legally provide you with an amortization schedule on day one, but they are quietly, and usually correctly, betting that you're going to file that schedule in a drawer, never look at it again, and just pay the default amount.
Section 4. Hidden rules and penalties.
Moving on to truth number 5, we need to expose the cold reality of bank default settings. Specifically, how things like overdraft fees and credit scores manipulate the spread in the bank's favor. These aren't accidents, guys. They are calculated system designs. Take transaction orders. American banks pull in billions on overdraft fees. So the crucial point is, historically, many banks process the day's transactions not in the order you actually made them, but from the largest dollar amount down to the smallest. Why? Because draining the account with your biggest payment first pushes everything smaller below zero. So a $5 coffee that tips your account negative doesn't just cost $5, it triggers a $27 to $35 overdraft fee, making that coffee cost $40. On a $5 shortfall paid back a few days later, that is an effective interest rate in the thousands of percent. Free checking is usually paid for the hardest by the people who can least afford a single bad week.
And our sixth truth is about the one number you actually can control, your credit score. Your credit score sets the rent on every single dollar you will ever borrow. The gap between a fair score and an excellent one can be well over a full percentage point on a loan. Running on Sarah's $400,000 mortgage, getting an 8% rate instead of a 6.5% rate costs her about $46 more every single month. Over the life of that identical loan, that 3-digit number costs her more than $145,000 extra. The bank doesn't keep a secret cheaper rate just for rich people. It keeps a cheaper rate for people who are cheap to lend to. Every point you raise your score naturally narrows the spread on every loan you take.
Let's move to Section 5 and see how this builds reclaiming your spread.
So, we've seen the 6 ways the banks take the spread by default. Now, it's time to stop losing money and reclaim your spread. The bank is absolutely counting on you finding this boring or too difficult to change. But flipping these defaults back in your favor is totally within your control. Step 1, move your idle cash into a high-yield account with the exact same insurance. It costs you nothing but filling out a form. Step 2, always pay more than the minimum on anything that charges you interest, so you stop paying pure rent. Step 3, send a little extra directly to your mortgage principal early while it still severely bends that amortization curve. Step 4, simply opt out of overdraft coverage so a card declines instead of charging you $35 and turn on low balance alerts. And finally, Step 5, start nudging your credit score up by paying on time and lowering your credit utilization because that lowers the rent on absolutely everything.
To wrap up our explainer today, I want to leave you with this final provocative thought straight from our source material. A bank is a spread machine. Which side of the spread are you standing on? By default, the system quietly puts you on the wrong side, but you have the power to run the numbers, change your settings, and take your money back. Don't take anyone's word for it, really. Run your own numbers today and make absolutely sure you're standing on the right side of the spread. Thanks so much for joining me on this explainer, and keep learning.